Hello guys, welcome to the channel. Yes, so please make sure that you subscribe to the channel, and for other extra benefits you can join as a member so you can get some NBT courses for free. There's a lot more stuff that's coming in when you join in as a member, but yeah, yes, so that's pretty much it. So today I'm going to be doing some accounting videos, and this is going to be continuous. I know that I started last time and I didn't end up finishing and stuff, and so I'm going to basically start from the beginning. So I'll cover the stuff that I covered in the last video, then I'll just also make sure that I do share the notes and the stuff that is in the video, so you can check that stuff in the description. And yeah, so without much further to do, I think let's just go straight into it. So today we are looking at a November 2024 paper. So in this video we're going to be specifically looking at question 1, and then in the next video we're going to look at the rest of the other questions. So question 1 here is focusing on financial statements. So there's a substantial amount of marks, basically a third of the paper. It's 55 marks, 45 minutes. And we have the following questions to answer. So we need to refer to the information B, that is for fixed assets, and then we need to calculate depreciation and equipment, cost price of vehicles, depreciation of vehicles, profit and loss of vehicles, and then after that we'll complete the statement of comprehensive income for the year ended 29 February 2024. So it says here that some amounts are provided for in the answer book, and that is why I have the answer book here, but I will be doing the answers on the sheet over here. So I've already basically numbered it, and then we'll see how we do this because I want to show the workings. Alright, cool. So let's get to it. So the first thing that we need to do is to calculate depreciation, and that is for 2 marks. So I expect it to be easy to calculate because it's just only 2 marks. And let's see the information that's given here. So obviously here we basically got these balances, and then we got this information BI, which is basically on fixed assets. And here they gave us information that makes it very, very simple to basically be able to calculate the depreciation and equipment, because they said no equipment was bought or sold during the year. And so if this is the case, so it means that if you think about the ledger account of accumulated depreciation and equipment, it would have an opening balance on the credit side, and then depreciation for the current year on the credit side as well, and so that would constitute the accumulated depreciation at the end of the year. And I'm saying this information because since we're given that, we can basically look at accumulated depreciation on equipment, and we just see that the balance between the beginning and the end of the year is basically the current year's depreciation. And so we would say that it's 344,700, which you would subtract from 472,500. So let's go and do that. So 472,500 minus 344,700, I think. Yes, 344,700. And then we can be able to get our answer, and our answer for that question is 127,800. All right, moving on. The question that follows, what does it say? So let's go to the questions. We need to calculate the cost price of vehicles on the 29th of February 2024. Key thing, the 29th of February 2024 is obviously the end of the year, and if you look here, vehicles at cost, we basically have a question mark at the end of the year. So let's look at some of the information that we're given and see if we're able to work out what these vehicles would be worth at the end of the year. Okay, so what does it say here? Well, it says that vehicles, an old vehicle was traded in for a new vehicle. So one vehicle was disposed and then the other vehicle was purchased, because a trade-in basically comes with that deal. So the new vehicle that it was trading for was costing 320,000. The trading value received on 153,660, and then it says the following extract of the vehicle that was sold was taken from the fixed asset register. So let's have a look. So this vehicle had a cost price of 240,000, and because we're working out the cost price, the information about accumulated depreciation and the value of the trade-in is not really relevant. What is relevant is basically the cost price, and you need to also now think about the ledger of vehicles at cost. So vehicles at cost, the way in which you calculate vehicles at cost, we would take the cost at the beginning of the year, right? And then we would add additions at cost, and then we would say subtract the cost of the disposed vehicle. So key thing here, because when you dispose a vehicle, usually there's so many amounts flying around, so you need to know exactly which amount you're looking for. So we're looking for these three things: cost at beginning, additions at cost, and then the cost of the disposed vehicle, which we're going to subtract. So let's see if we can basically then be able to replace these amounts. So in terms of the cost at the beginning, I think that was already given in the list of balances here, because we have vehicles at cost showing at 1,250,000. So that's going to be 1,250,000. And then additions, so which vehicles were brought into the business during the year and what is their cost. So obviously we traded in an old vehicle for a new vehicle that has a cost of 320,000. So then additions at cost, we would have a 320,000. So we're going to add 320,000 there, and then we would subtract the cost of the vehicle that was disposed. And if you read well, you would see that in the asset register, this is the cost price of the disposed vehicle. And so we'll subtract that, and that will give us the cost of the vehicles at the end of the financial year, and that works out to 1,330,000. All right, cool. So hopefully that makes sense. Now let's move on to the next question. The next question says we need to calculate the depreciation on vehicles, and if you do remember well, there is an amount that is provided here when you're calculating this depreciation on vehicles. So there is depreciation on remaining vehicles, and then we have two other classes of vehicles, which is the depreciation of the new vehicle and then the depreciation on the vehicle traded in. And then if we add up those three, we will get our depreciation on vehicles for the year ended 29 February 2024. Okay, so let's do that. So okay, 132,720. So depreciation on the remaining vehicles would be that, and then now we need to look at the depreciation on new vehicles, and then depreciation on disposed vehicle. Okay, cool. So let's try to work this out. So let's start with the new vehicle. So the new vehicle is going to be a bit straightforward, because it doesn't matter too much the depreciation method. It just matters in terms of what's the percentage, because it hasn't yet been depreciated, so we're always going to go with the cost. So we can see here that vehicles are depreciated at 20% per annum using the diminishing balance method. And also this information, as much as they gave it on the answer sheet, they also gave it in the information, so that's good. So let's take the first vehicle then. So the vehicle costing 320,000 currently has no accumulated depreciation, so that's 320,000 minus 0, which is 320,000. And then we're going to multiply by 20%, and then we're going to multiply by the number of months that it was in the business. So obviously our year ends on the 29th of February 2024, and so we have to count the months from when it was traded in to the end of the year. So it was traded on 1 September. So we're going to count September, October, November, December, January, February. So that works out to 6 months. So then we're going to say, to calculate the depreciation on the new vehicles, we're going to say 320,000, then we're going to multiply by 20%, and then we're going to multiply by 6 over 12. Alright, so it was basically here for half of the year. And so that would give us 32,000. And then after that, to work out the depreciation on the disposed vehicle. Now, the disposed vehicle, it's likely going to be different because it starts off with an accumulated depreciation. So if you look at that, it would have had a cost price of 240,000, but at the start of the year, it had an accumulated depreciation that is given here, which is 73,600. And then it was in the business until 1 September 2003. Well, if there's 6 months after that, then there would have been 6 months before. So it's also going to be a 6 over 12. And you can count the months because the year starts in March 2023. So March, April, May, June, July, and August. So that's 6 months. So then to calculate depreciation in this case, what we would do is we're going to say, well, the cost, which is 240,000, all right, so 240,000 for the cost, minus the accumulated depreciation at the beginning of the year, so that would be minus 73,600. Please remember that this is the accumulated depreciation at the start of the year. And then after subtracting that, we then would get our carrying amount, which we would then multiply by 20%. And then remember that this vehicle was only here for 6 months of the 12 months as we disposed it after 6 months. So we're going to multiply by 6 over 12. And then that would then allow us to get to a final amount for depreciation on vehicles. Okay, there must be a mistake in there. I think maybe I put an extra 0. Yes, I did put an extra 0. I said 2.4 million. So there it gives us 16,640, and then we basically would work out the total. So, you know, when you work out totals, please remember, guys, that you get method marks. So even if maybe you work this out wrong, but the fact that you added everything, you get that method mark. So always make sure that you are leaving absolutely no blank spaces, okay? All right, hopefully you understand me. All right, cool. So the next thing now that you're going to go into is 1.4, and 1.4 is asking us to calculate a profit or loss on the vehicle traded in. So okay, so in this case then we just need to see, well, the trade-in value. So how much was it valued at the trade-in? So the trade-in value of this vehicle, I remember that it was 153,660. So 153,660. Also, let me just quickly check the answer sheet so you can see that it doesn't give much. All right. Then the next thing we're going to look at is the carrying amount of this vehicle. So carrying value. And this is the carrying value on 1 September, so on the date that it was sold. So on the date that it was sold, it would have had a carrying amount of, well, 240,000. Subtract the depreciation, subtract the accumulated depreciation at the beginning of the year, which is 73,600, and then subtract the current year's depreciation. So the current year's depreciation is 16,640, and so that will give us the carrying value of this vehicle. So the carrying value of this vehicle is 149, and it was traded in for 153,660, and based on this, then it would have been a profit. So we have a profit on sale of asset. So the profit on sale of asset, we'll just take 153 minus 149, and that is giving us 3,900. Okay, cool. So that's basically then the start to the first question, which is 1.1, and we're going to now be moving to 1.2. You'll see here that I've just prepared some of the things that I want to highlight as giving you this information, but we'll get to that part. And then also we are making use of our what is this? We're making use of these numbers over here, so you can see that those areas that are highlighted basically already have numbers. So I'll just come take from the answer sheet when I get to that, so that we don't waste our time trying to figure out that. So quickly going to take cost of sales here, so that's 4,780,900. So cost of sales, 4,780,900. So this is going to be our cost of sales. So it's going to be here, so I'll put cost of sales here. And then the thing that I have to put above that is the sales. Okay, so let's see then. So again, let me just make sure I come back to check that question and read it, So yes, it says that you need to complete the statement of comprehensive income for the year ended 29 February 2014. Some amounts provided in the answer book. So as it says, all right. So as you can see, for sales that we're looking for, we're not given the sales, but let's look at the information that we've been given as it relates maybe to how we can calculate the sales. Okay, nothing much said, so the other information about vehicle, and then here we told about a markup. So the company maintains a markup of 60% on cost. It says that note that goods costing 115,000 included in the cost of sales were sold at a markup of 40% on cost to internal employees. Alright, so basically we use a normal markup of 60%, but sometimes we make exceptions to our employees. So we basically have to then separate our cost of sales into two, the ones that are marked up at 60% and the ones that are marked up at 40%. So as you can see here then that we basically got cost of sales that have already been given, 417,900. We know that they are internal ones, which are 115,000. I must make this a number. Okay. So we got 115,000, and then we got the other cost of sales, which are basically 4,780,900 minus 115,000. So these ones are at 60% markup, whereas these ones are at 40% markup. Okay, and so what we're going to do then for our calculation, we're going to say, well, 4,665,900, and then we're going to apply a markup of 60% on cost. So I'm going to say multiplied by 160 over 100. And then we're going to add the other sales, which is 115,000, but then these ones are going to be marked up at 140. So we're going to say 100 plus 40, which is 140 over 100. And then that would give us our sales. So the sales then work out to 7,626,441. And then let's remember that with the cost of sales, obviously we'll put that in brackets. So as we put that in brackets, we then would have a gross profit. I don't know. Okay. Yeah. Gross profit. So our gross profit is basically then sales minus the cost of sales, which gives us 2,845,000. So this is always a mark that you should get because it's a method mark. And in case you weren't able to calculate the sales, well, what I would suggest do is that maybe make up a number for sales so that at least you do get that mark for the gross profit, because if you apply the right method, even if you have the wrong sales amount, you will still get the method mark. So please make sure about that. And then we'll move to the next part of our statement of comprehensive income, which is other income, and we have service fee income to start with, which is 1,757,700. So I'm going to start there. 1,757,700. Yes, and that is fee income. All right, it's fee income, service fee income. Okay, it's fine. All right, so that's our other income. So now let's look for the other incomes. So one of the other incomes that we need to just do very quickly is the profit on sale, because we already have it from the previous question. So profit on sale of asset, and then you don't need to do workings again because you already worked it out. So you can just say refer to 1.1.4, and that is basically going to be 3,900. Now again, if you got this number wrong but you were able to use it correctly here, then you would get the method mark. So again, no need to lose marks in that situation. And then we'll move on to calculate the rental income. Okay, so with the rental income, let's say some of the information given first. Okay, rent income, we're given 158 to 100, and then let's find the information relating to rent income. All right, there is information VI, so that's number 6. A tenant is renting an office from Ivory Park Limited. Rent for this office has been received up until 30th of April 2024, and then the rent was decreased by 8% on 1 December on the office that was rented. Okay, cool. So we basically received rent for 2 months more than we were supposed to. Okay, so let's then see how we would work out the rent in this case. All right, so I'm going to do my workings right here. So let's think about our financial year as it relates to the rental income. So we got our financial year, right? Because we basically, well, we have a date that it starts, so it's 1 March 2023, and then we continue until there's an increase on 1 December, so I think it's 1 December 2023, and then there's a financial year that ends on the 28th of February 2024, but then we go on and receive the rent until the 30th of April 2024. So if you can be able to just do this quick timeline, and then also just write the notes in terms of what is it. This is the start of the year, this is the day the rent increases, this is the end of the financial year, and this is the date until we received the rent for. All right. Yes, so okay, it goes up on 1 December, not on 31 December, so just make sure we correct that. All right, so let's look at the different periods. So now in this case, because we're given a percentage, we're going to work out our rent using percentages. So for the first part of this year, so for the first part of the year, if we look at it, we basically would have been receiving the rent at 100%. So we're getting 100% of the rate from 1 March to 1 December, and that's basically what? That's 9 months. And you can work it out. So we're going to say, well, 9 times 100% is basically going to give us 900%. Okay. And then after that, we received the rent from March up until this date. So from 1 December until the 30th of April 2024. So now, how many months is that? So that's December, January, February, March, April. So that's 5 months. So you're going to say 5 multiplied by 92. So 5 multiplied by 92%, because remember that the rent decreased by 8%. So 100% minus 8. And 5 times 92, let's just quickly work it out. That's 460. So this is going to be 460%. And so the total rent for 14 months, because remember this is 9 months plus 5 months, so for 14 months we would have received rent that is equal to 900% plus 460%, which is basically 1360%. All right, now in percentage equivalence, this in percentage equivalence, this basically means that the total rent, which is given in the trial balance as 158,100, right? This 158,100 in percentage terms is equal to 1,360%. So then what we'll do then to calculate, because ultimately what we want to do here is to basically say 158,100 minus the 2 months of rent. And the 2 months of rent, that what I'm talking about is basically the March 2024 and April 2024, because we basically received rent for 2 extra months. Now those months, those 2 extra months, what are they? Those 2 extra months so months of March 2024 and April 2024, that is basically 2 months, right? That is 2 months, and that would in percentage terms, that would be 92% times 2, 92%. So let's say 92% times 2 would work out to 184. So that's basically 184%. So basically we want to take out 184% then in this case. And to work out that 184%, we basically just say, well, 158,100 multiplied by 184, which is basically the rent for 2 months that are outside the financial year, divide by the total amount of rent that had been received, which is 1,360, and then that will give us the monetary amount of 21,390. So then for rental income, 158,100 minus 21,390. And then let's see what that will give us, 21,390. That basically then gives us 136,710. Okay, hope that is clear, and you know, you can play with pretty much an increase or decrease, whatever the case is, so that you can understand this concept. But it comes up so many times, so important for you then to make sure that you understand it. All right, cool. So then now we're gonna move and see if we have other incomes, and I've basically done these blocks based on the answer sheet. Typically they'll, they will, if there's 5 blocks, it probably means you have 4 incomes, because they will leave you like one more space for you to make a mistake if you want to make one. So they just never give you the exact amount of blocks needed. But let's see. I'm not saying it's always going to be the case, by the way, so just take that part with a grain of salt. All right, so the next thing now that we are going to look at is maybe if there's any other incomes that we need to still calculate. Based on this, you can see that we got rent income. We don't have bad debts recovered, we could see here. Interest income, consider later. Director's fees, interest and loan and stuff like that. So we don't have other incomes to consider, sorry about that. But then we need to consider other things like a trading stock deficit, a trading stock surplus. So trading stock are given 654, and if we look at the information that has been given, we have 647. So you can see in this case we have a trading stock deficit, which we'll deal with later. And then the other thing we can look at is provision for bad debts adjustment. Here it says that we must provision for bad debts must be adjusted 5% of the outstanding debtors. So now when you get this information, one of the things that you need to look for is to look for, well, before they said this, what transactions were reported that were affecting debtors control. Luckily in our case there wasn't any, but if there was, we would need to first take that information into account, and then after taking that information into account, it could either decrease or increase, the debtors control. And if that's the case, that it increase or decrease, we basically work out that balance and then work out 5% of that. Now in this case there isn't information like that, and so what we will do then in this case is to just basically go to our list of balances and find our debtors control. So our debtors control is 516,600, and what is 5% of that? So 5% of that, so 516,600, let's work out 5% of that. So 516,600 times 5%, that is going to give us 25,830, and then now we have to compare with the previous year for provision for bad debts. Provision for bad debts last year was 25,520, and now it is currently decreasing to 25,830, and a decrease in provision for bad debts adjustment is basically an income then. So then we're gonna have provision for bad debts adjustment. Okay, and then we're going to calculate it as 29, because it's 29, how much? 29,520 minus 25,830, and then that is going to give us, let's see, how much does it give us? It gives us 3,690. All right. Cool. So I hope that this does make sense. The next thing that we need to check for maybe would be bad debts recovered. Doubt there is, but it'll just be good to check. There isn't bad debts recovered here, and so we can move into the next part of our statement of comprehensive income. So now we just need to add up our incomes. Now this is another method mark that's easy to get, because whatever incomes that you add, if you make up the right total, then you should be able to get your method mark here for other incomes, and there you go. Our other incomes work out to 1,902,000. And then from here, we will then have gross operating income. So gross operating income is going to be our gross profit plus other income, which works out to 4,747,540. And then after that, we look at our operating expenses. And by the way, again, this is another method mark, because if you add up your gross profit and other income, even if the numbers are wrong that you got there, the fact that you know that you need to add them to get gross operated income, you will get a method mark. So again, no time to be leaving blank spaces. All right, operating expenses. So we got 3 to start with from the trial balance. So we got audit fees, sundry, and bad debts. So I'm going to say audit fees, sundry, bad debts. Let me just input the amounts. So the amounts are 79,000, 119,900, 119,900, and then lastly it's 24,780. 24,780. All right. Happy with that. Now let's move on to the second part, and now to move on. Okay, so now we then move on to the other expenses that were not given in the answer sheet, and we're just going to go according to the list. So the first expense that is on the list after the bad debts here is our packing material, and in this packing material we can see that we're given 66,550, and then let's look at the adjustment that has been given, and it usually goes with the stock take. So you can say physical stock take, it revealed the trading stock, which we'll deal with it at a later stage. And then there's also packing material used during the financial year, which amount to 58,700. But then the key thing here, they said used. So basically the material used is the one that is an expense, and the one that is on hand is the one that becomes an inventory when we do the statement of financial position. So our expense here is just straight up going to be 58,700 because that's how much has been used. So then we would say that packing materials, and then we would just have 58,700. All right, and then let's move on to the next expense. So the next expense is salaries and wages. So salaries and wages, so the way in which this one goes, it says that it includes contributions as well. So typically when you do salaries and wages, you're going to be told about one omitted employee, and you then basically need to include them. But the most important thing to understand about it is that whatever amount that you want to calculate for salaries and wages, it has to be the cost to company. What does it cost the company to have this employee? And it costs the company the gross wages they pay to the employee plus the contributions that the employer makes towards the employee. And so in that case, you need to always just be more alert to kind of just make sure that you understand that very, very thoroughly. And yeah, and let's have a look then at how we can basically just be able to work this out. So let's look at the information. So what does the information say about these wages and salaries? Well, it says that, I think it's information number 7. One employee was omitted from the salaries journal of February 2024. The net monthly salary was 19,340 after 35% deductions were made for pension and personal tax, and then also after the 200,000 was deducted for the medical aid. And then this employer contributes 10% of his gross salary on behalf of employees towards pension. Okay, so let's try to break this down. So this person gets a gross salary, right? So we pay them a gross salary. So the gross salary in any percentages, we can pretty much say it's 100% of their salary. And then from that salary, there are deductions before the employee can make payment to your bank account. So the deductions that were made in this case, firstly were 35%. So they just gave us a rate in this case. So this is 35%. This is 35% towards pension. It's 35% towards pension and tax, right? Cool. But then we don't know the amount, right? Cool. And then there's also the medical aid. Now the medical aid is 2,500. So let me put this here, by the way. And then the medical aid is 2,500. And this is also a question mark in terms of what the total is. And then basically from net salary, what is our net salary? Our net salary is going to be, our net salary would have been whatever the amount is, but then the net salary that we're looking for here is basically the net salary before medical aid. So net salary, okay, let's get the net salary first and then go before medical aid. So the net salary that we got was basically 19,340. I think that was the amount given. We just double check. Yes, 19,340. And then let's work out what is our net salary. And then let's reverse the medical aid, because basically we're trying to get to the gross salary. So we need to reverse the medical aid, right? Because we deducted it. So to reverse it, it's 2.5. And then the other thing that we would want to reverse is pension and tax. But then pension and tax, we can't really put a rand amount there, but we know that it is 35%. And so what it would give us, and so what we would then get, if we were to just add back or reverse that medical aid, we would basically get our net salary, but this would be the net salary before deducting medical, pension and tax. So net salary before deduction, sorry, no, this is the net salary before deducting medical aid, right? Because we haven't added back the pension and tax because we don't have the value. And so that would work out to 19,340 plus 225. And this amount is basically what? Well, this amount is basically our 65%, because we would basically say, well, if this is 100%, and then these deductions that we talk about here are 35%, then this would work out to 65%. And the key thing that we want to work out anyways is basically the gross amount. So what is the gross amount? Well, the gross amount is going to be our 21,840 multiplied by 100, because that's what we're looking for, divided by what we have. What we have is 65. So what you have is 65. We then get a gross salary of 33,600. And then when we do our calculation here, we're going to start with the amount from the pre-adjustment trial balance, which is 1,425,600. And then you're going to say plus 33,600 because that employee was omitted. And then now we also need to add the contribution. And if you remember, the contribution is 10% of the gross salary towards the pension. So then we can then say add 33,600. So we're adding 10% of that. And so if you add 10% of that, it will then give us 142,460. All right. Hopefully that makes sense. And yeah, and so that's basically how we would work out that one. Bit complicated than usual, but still the same principle. So let's move now to more other expenses. So the next expense in the list is insurance, and we're given 100,800. Now with insurance, typically the case is that you have prepaid for the insurance, and let's look if maybe that is the case. Okay, there's the directors and stuff like that. Oh yeah, there's the monthly insurance. So it says monthly insurance premiums were fixed for the past 3 years and were paid up to 31 May 2024. Okay, so monthly insurance premiums were fixed, paid up to. Okay, cool. So okay, cool then. So they haven't changed, and we've paid until May 2024. And so how many of those months lie outside the financial year? It's basically March 2024, April 2024, and May 2024. So then we would take our 100,800, then multiplied by the months that are inside the financial year, divide by the ones that are outside. Another alternative would have been to calculate the 3 out of 12, and then after that you come and subtract it from the 100,800. So that would be another way to perhaps look at it. But yeah, either method will work. The next thing that we want to then have a look at is when it comes to the director's fees. Let's see, so we got this, and then it's director's fees. So director's fees, what did they say? So we got director's fees, and we're not even given an amount for director's fees. And what falls after director's fees? Okay, we have nothing else in the list after director's fees, and so it means that we're probably going to get it here. And then the other thing we need to consider is basically the depreciation. And the nice thing is that we have worked out the depreciation on equipment, and we worked out the depreciation on vehicles in that first question, and so we will just basically use that. All right, so let's start with the director's fees and look at the information. It says that the company had 2 directors who received a combined annual fee of 1,065,200 after their monthly fees were increased by 5,800 on 1 August 2023. And then it says the third director joined the company 1 November 2023 and received the same monthly fee as the other directors, excluding the increase of 5,800 per month. Okay, so basically we just need to figure out how much the third director earns, and then we add along with what the other directors are earning, and yeah, we'll be able to figure that out. Okay, so let's think about the first 2 directors, which they have a case which is slightly a bit more straightforward. So let's start with the 2 directors. So 2 directors, they earned, and remember that we want to look at earn when we look at income. So they earned an amount of 1,865,200, and then we then want to look at one director. So one director earned, well, the other director would have earned, I think it was from November. So they earned November, December, January, February. So they earned for 4 months in the current year, multiplied by their salary, and then we need to basically then be able to work out this salary. So, so the first thing then that we need to do is to think about, well, if we can take that amount of the directors and divide by 2 and then divide by 12, it would give us how much these directors earn. But then we need to think about the fact that these directors got an increase during the year. So the first thing that we want to do is to basically take out the effect of that increase. So we have a total of 1,065,200, and then we want to take out, so we're going to say less the effect of increase. So in other words, of increase. So in other words, what we're basically trying to get here is to work out how much would these directors be earning if they didn't get an increase, because the other director basically earns the amount before the increase because they didn't get the increase. So it does say in the scenario there that they earn the amount that would be before the other directors got an increase. So then in this case, what do we need to do? So we're going to say, well, the increase was 5,800 and it was gotten by each director. And then for how many months was it? It was from 1 August, so 1 August to 28 March 2024, that would be 7 months. So then we would multiply by 7, and then let's see how much that increase would have been. So that increase would have amounted to 81,200. So then if there was no increase, how much would these directors would have earned? They would have earned 984,000. So now if they earn 984,000, well, let's each one director, so one director earns half of that, right? So one director earns 984,000 divided by 2, so one director earned 492,000, and then per month, so one director would have earned 492,000 divided by 12. So they would have earned 82,000 per month if so they would have earned 82,000 per month. Wait, let's see, is it 82? That seems quite high. Yes, I put the wrong amount. It should have been 492,000 divided by 12, which works out to 41,000. So they would have earned 41,000 per month. And so the other before the increase, so after the increase, it means they earned 46,800. But the new director only would have earned 4 times the salary, which would have been 41,000. And so 4 times 41,000. So 4 times 41,000 would be equal to 164,000. And then that would mean that for our director's fees, we'll then have 106,200 plus 164,000, and that would give us a total of, let's see, 1,229,200. And then let's move on to the other things. So the first thing that you're going to consider is depreciation. And then let's remember that our depreciation, we already did calculate this. We just need to go above in the information. Remember that the first question was the depreciation on equipment, which is 127,800. And then we calculated depreciation on vehicles, which was here 181,760. And in this case, you can even just reference the depreciation amount to question 1.1 and 1.3, I think. So that's what you get for depreciation, 309,560. And let's see, so yes, I think I said 760 here instead of 360, sorry. Oh, and then you have to do it here. Okay, cool. And then the other expense is going to be the trading stock deficit. So that trading stock deficit is, well, we're going to look at how much we got in the list of balances, which would be 654,500. And then subtract the stock count, which was showing 647,100. 647,100. And therefore, you get 7,400, and I think that's pretty much it. Obviously, you know, that one extra space is typically just a rope to hang yourself with, but don't fall for it. I'm not saying it's always going to be the case, but just be aware of this. I would like you to even check it in other questions to see the consistency that they keep with. And then after that, we'd add up our expenses, right? Because we got all our expenses. And so that gives us expenses, which is 3,371,340. And then want to look at what we're given next. It's only the net profit at the end, and then also the interest expense. So let me just put that information in right away. So 992,160. This is tax, profit before tax, and therefore that would be 149,400. Okay, so that would mean then that we would have an operating profit, which would be gross operating income minus expenses. And again here, this is another method mark for simply doing that calculation, even if your totals are wrong, it doesn't matter. This is another mark, by the way, as well, because if you add up all your expenses, regardless of whether you got them wrong, but the fact that you need to add them, you get a mark. And then after that, we have to look at the interest income. Well, I'm not really too interested in finding the interest income, but if we are able to find it without calculating, then I would go for that route. Now, being given a profit after tax, it means that you can basically try and find income tax, and then if you find income tax, we can have the net profit before tax, and then we see if we can be able to plug through these amounts. So this is the net profit before interest expense, and then this was the interest expense. So let's see if we can fill out this information without having to look at the information. So what do they say about maybe the tax rate, because that's what it would give it away. Says income tax is calculated at 28% of the net profit. So then this would be what? This would be 72%. This would be 28, and then this would be the 100%. So then to calculate this, would say, well, income tax is basically what? 992,160 multiplied by 28 divided by what we are given, which is 72. So that gives us our income tax. And just remember that when we show income tax, it has to be showing as a negative. So there we got our income tax, and then we can work out our profit before tax, which you can also work out using basically the same method. It's just you're going to say 992,160 multiplied by 100 over 72, or you can simply say 992,160 and then add the 385,840, which is what I will do. And make sure that you add and not subtract, because remember that when you're going up, you basically just reverse what you did. So we subtracted to go down, so to go up, we'll just add what we subtracted. Then it gives us that 1,378,000, and then our net profit before interest expense again is the situation where we can take the 1,378 and then add 149,400, and that gives us 1,527,400, and therefore the difference between the two, operating profit and the net profit before interest expense, the difference would be the interest income, and that would work out to 151,200. And so I think that would then basically complete the question 1 of this paper. So we covered 1.1 and 1.2, and so yeah, so that would be just it, and we can pretty much take it from there. And yeah, so stay tuned for the next video that is going to be on question 2 of this very same paper. Cheers for now. I will see you on the next one. Bye bye.